Okay, stop. Just put the phone down. Don't open the trading app.
Yeah.
It is Monday, February 2nd, 2026, and if you haven't looked yet, I'm going to do you a favor and tell you it is ugly out there.
Ugly is a very polite way of putting it. It looks like a crime scene on the charts this morning.
I mean, I woke up, checked my notifications, and it was just a wall of red. For everyone listening, if you're feeling that pit in your stomach, you are definitely not alone.
Oh, for sure.
But the whole point of the show is to stop panic scrolling and actually figure out what is going on. Is the sky actually falling, or is this just a really, really bad Monday?
It's a bit of both, honestly.
Hmm.
But you have to separate the noise, the price action screaming at you, from the actual signal. We have a stack of reports today that paint a pretty clear, albeit intense, picture.
So we're looking at a crash, obviously. Bitcoin has taken a nosedive.
A significant one?
But we're also looking at something much bigger than crypto prices. We've got data on the U.S. national debt that is frankly terrifying, and a stress test document from the Federal Reserve that, well, it reads like a horror movie script.
It really does. It's a glimpse into the Fed's worst nightmares.
And we're going to talk about India because it might be a blueprint for how governments worldwide are going to come after your assets. So, the mission today, connect the dots. Is this the moment to buy the dip, or is this the start of the big one?
Let's get into it.
All right, let's rip the Band-Aid off. I'm looking at the numbers from MEXC News and the new hedge dashboard. Where are we actually sitting? Because last time I checked, we were talking about Bitcoin hitting 100K.
We were close. I mean, mid-January, Bitcoin was north of $95,000. The six-figure party was basically planned. And now? But in the last 2 weeks, the floor just fell out. We're
Yeah?
trading around 75,500 this morning.
Wait, hold on. That's a $20,000 drop.
In 2 weeks.
What?
Correct. It's one of the sharpest corrections we've seen in a while. And it's not just the price. It's the sentiment. The fear and greed index.
Yeah, that little speedometer that tells me if everyone is euphoric or terrified. Where is it?
It's at 14.
14 out of 100.
That's extreme fear. We haven't seen it that low since mid-December. The market has completely flipped from we're going to the moon to is it going to zero?
But why? I mean, markets go down, sure, but a $20,000 candle, what triggered that?
A lot of it is leverage. When everyone is betting on the price going up, they borrow money to make those bets. The new hedge dashboard shows that $2.5 billion worth of leverage positions were wiped out.
2.5 billion.
Gone. Vaporized. And that creates a cascade. The price drops a little, someone gets margin called, their assets are sold automatically, which drops the price more, which triggers the next guy.
It's a domino effect.
Exactly. It's a flush out.
So the casino's just clearing the table.
Precisely. And the damage isn't contained to Bitcoin. Altcoins are bleeding out. SUI is below $1.10. Ethereum is down. It's a broad market sell-off.
Okay, so here's the question everyone is asking right now. You've got the classic Warren Buffett line, be greedy when others are fearful.
The favorite quote of every bag holder.
Right, and you've got guys like Robert Kiyosaki shouting that this is a sale. But I was reading the comments on the new hedge dashboard, and people are torn. You've got one person screaming, time to buy, but then another one saying, bloodbath not over just yet. Who do we believe?
That is the million-dollar question. Is this a discount or are we catching a falling knife? But to answer it, you can't just look at the crypto charts. Crypto doesn't exist in a vacuum.
Right.
You have to look at the macro environment. And right now, the macro environment is heavy.
You're talking about the debt thing. I saw the Deloitte report in our stack, and I'll be honest, the numbers were so big, they started to lose meaning.
That's the problem. We get desensitized to trillions. But let's try to ground this. The U.S. federal debt is at $36 trillion.
Which is what, as a percentage of the whole economy?
That's 119% of the country's entire GDP.
Okay, but we've had debt forever. People have been screaming about the debt since I was in high school. Why does it matter today?
Because of the interest rates. When debt is cheap, it's fine. But interest rates aren't zero anymore. In the first 10 months of fiscal year 2025, the U.S. government paid $841 billion just in net interest.
Just interest, not paying down the principal.
Pure interest. To give you context, and this is the stat that should keep you up at night, that $841 billion is now higher than what the federal government spends on Medicaid.
Wait, say that again? We are spending more on interest payments to bondholders than we are on health care for lower-income Americans.
Yes, the credit card bill is now costing more than the groceries, and this creates a phenomenon called fiscal dominance.
Okay, I saw that term in the report, fiscal dominance. It sounds like a bad political thriller. What does it actually mean in plain English?
It means the Fed loses control. Normally, the Federal Reserve's job is to fight inflation or help employment.
Mhm.
But when the debt is this big and the interest payments are this high, the Fed might be forced to keep interest rates lower than they should be.
Just so the government doesn't go bankrupt.
Exactly. So they can't fight inflation because if they raise rates, the government can't afford its own bills.
So they become subservient to the debt?
Precisely.
Ugh.
And the rest of the world is noticing.
I assumed that's why the dollar has been weird lately. Usually when there's panic, everyone buys dollars. It's the safe haven. But looking at the charts, the dollar is down.
It is. Since January 2025, the dollar is down nearly 13% against the euro and almost 7% against the yen. That is a massive move for currencies,
And foreign investors.
especially China. They're backing away from U.S. treasuries.
So they're dumping dollars. Where are they going?
Gold. Central banks bought 410 tons of gold in the first half of 2025. Gold has actually flipped the euro to become the second largest reserve asset in the world.
Okay, stop. This is the part that drives me crazy. If the dollar is dying and the government is broke and everyone is terrified of the debt, shouldn't Bitcoin be going to the moon?
That's the pitch right
Isn't that the whole pitch? Digital gold. But Bitcoin is down 20 grand. So why isn't the digital gold acting like actual gold?
Because right now, the market doesn't view it as gold. It views it as a tech stock. We have a report here from Flipster that analyzes the correlations. Recently, Bitcoin's correlation with the NASDAQ 100 hit 0.7.
Break that down for me. 0.7 implies what?
It implies they are hip to hip. If NVIDIA and Apple tank, Bitcoin tanks. It's trading like a risk-on asset. When investors get scared of a recession, they sell their risky bets to get cash.
So they sell tech and they sell crypto.
At the same time.
So it's not a hedge, it's just more exposure to the same thing.
In the short term, yes. The Flipster report makes a great point. Bitcoin is scarce like gold, but it's held by people who treat it like a tech stock. So when liquidity dries up like it did in March 2020, it crashes with everything else.
Okay, so we've got a crashing market, a debt crisis, and Bitcoin acting like a nervous tech stock. But I want to get to the document that really freaked me out. The Fed's stress test scenarios for 2026.
Yeah, this is the heavy stuff.
Just so we're clear, because I don't want to start a riot, this isn't a prediction, right?
Yeah.
The Fed isn't saying this will happen.
No, it's a what if. Every year, the Federal Reserve tests the biggest banks, JP Morgan, Bank of America, all of them, to see if they would survive a catastrophe.
Yeah.
They make up a hypothetical, severely adverse scenario.
Right. But they don't pick these scenarios out of a hat. They pick things they are genuinely worried about.
Exactly. They test for plausible risks, and the scenario they cooked up for 2026 is, it's brutal.
Walk us through it. What does the Fed think a bad day looks like?
Well, first, they're testing for unemployment spiking to 10%,
10%.
a massive jump from where we are. But the market numbers are what stand out. They are testing for a 54% decline in equity prices.
Whoa, hang on. A 54% drop in the stock market?
Yes. Imagine cutting the S&P 500 in half.
That wipes out retirement funds. That wipes out everything.
It destroys household wealth. And they're also testing for the VIX, the volatility index, to spike to 72.
We said the fear index is at 14 right now. What does a VIX of 72 even mean?
72 is total systemic panic. For context, during the absolute worst of the 2008 financial crisis, the VIX hit those levels. It means markets stop functioning properly. You can't find buyers.
Banks stop lending.
It is pure chaos.
And real estate.
House prices down 29%, commercial real estate office buildings, malls down 40%.
It sounds like the Great Depression 2.0. But here is the thing I noticed in the report that was different from last year. Last year, they tested for a recession where inflation went down.
You spotted the key detail. This year, the scenario assumes persistently high inflation and rising prices for oil, gold, and gas.
So the economy crashes, everyone loses their jobs, the stock market gets cut in half, but gas and milk still get more expensive.
Stagflation. That is the nightmare scenario. Because if the economy crashes but inflation is low, the Fed can print money to fix it.
Right.
But if the economy crashes and inflation is high, they can't do anything. Their hands are tied.
That ties back to the debt fiscal dominance thing. If we hit this scenario, the safety net is gone.
That is why the stress test is so alarming. The Fed is quietly asking the banks, can you survive a world where we can't save you?
That is incredibly sobering. So we have the Fed preparing for the worst economic disaster in a century. And in the middle of this, governments are looking at that $36 trillion debt and saying, we need money.
Right.
Which brings us to India.
Yes, and I know some listeners might tune out when we talk about international regulations, but don't. This isn't just about India. It's about the global playbook.
The report from the Economic Times outlines India's budget 2026, and they are cracking down on crypto hard.
They are. Starting April 1st, 2026, they are introducing really strict penalties. If you don't report your crypto transactions, you get fined. If you report them wrong, you get fined huge amounts.
I saw the numbers, 50,000 rupees for inaccurate info. But why should a listener in London or New York care about a 50,000 rupee fine?
You shouldn't care about the rupee amount. You should care about what it implies. To enforce those fines, the Indian government needs total visibility into the blockchain. They need to know who owns what wallet.
The end of anonymity.
Completely. The report quotes experts calling it a shift from ambiguity to enforcement. And think about the debt we just discussed. The US, Europe, everyone is broke. They need tax revenue.
And there's this massive pot of crypto wealth just sitting there.
Exactly. India is just the first mover here. We also have XBTO's outlook in our notes, mentioning that 2025 was the year of institutional adoption. But institutions, BlackRock, pension funds, they don't invest in the shadows. They invest in regulated markets.
So if you want the big money to come in and pump your bags, you have to accept that the government is going to be watching every move.
That's the trade-off. Crypto is growing up. It's getting a suit, a tie, and a tax audit.
It feels like the walls are closing in a little bit. You've got the macro economy threatening to implode, the Fed preparing for stagflation, and the government's hunting for tax money. It's a lot to process.
It is heavy. And it explains why the market is red today. Smart money is looking at this landscape and taking chips off the table.
So let's bring this back to the person listening to this on their commute. They're looking at their portfolio, down 20%, feeling sick. We started this by asking if this is a buy the dip moment.
And look, I can't give financial advice, but if you look at the data, the correlation with tech stocks, the extreme fear, and the Fed's own worry about a 54% crash, it suggests that the downside risk is very, very real.
The digital gold narrative hasn't kicked in yet.
Not yet. If we hit that stagflation scenario, maybe Bitcoin eventually decouples and becomes the lifeboat. But right now, it's tied to the sinking ship.
That's a tough pill to swallow. But I think there's a really important takeaway here from the stress test.
What's that?
The Fed is spending millions of dollars running these simulations. They are asking, what happens to Bank of America if the world ends? They aren't hoping it doesn't happen. They are planning for if it does.
That's prudent risk management.
Right. So my question to you, the listener, is this. The biggest banks in the world are preparing for a 54% market drop and 10% unemployment. They have a plan. Do you? Or are you just looking at that fear index at 14 and hoping it magically bounces back to greed by tomorrow morning?
Because like they say in the trading pits, hope is not a strategy.
It definitely isn't. We gave you the signal. Now it's up to you to navigate the noise. Thanks for diving deep with us. We'll see you next time.